Okay, let's do it together. So we have all the area in yellow, which is the area we need to figure out. We'll just put here, what is the growth in sales for 2017? And we kind of remember that, but let's just do it the right way. So that number up top is 10%. So I'll just reference it here. 17 is 10%. Then we say, well, what's the operating costs? Operating costs is 90%. And what is the depreciation? Here we know it's as a percent of fixed assets, so we have to be a little bit careful. I'll just note here of fixed assets, whereas the other ones were of sales. So we're good to go. Let's start forecasting the income statement. So sales are last year's sales times 1 plus the growth rate of 10%. 2,200, we've seen that before. The operating costs are 90% of that number of sales. And then the fixed assets, we're going to have to estimate. So 10% times 2,000 times the fixed asset percentage, which is 25%. And that's 55. So now EBIT is sales minus operating expense minus depreciation. So that's 165. We're given the interest, which was 8% based on the beginning balance. That is 40. And then we're going to assume for now that we didn't borrow anything. So we take EBIT minus the interest. And that gives us pre-tax earnings of 125. For a tax rate, I'll put the rate here, is equal to the assumption we have above, which is 40%. So now we can use it. 40% times pre-tax. So our net income is 125 minus 50, or $75. Dividends are, the goal is 10% more than last year. So we take last year times, open parens, 1 plus 10%, or $22. Special dividends, if we have excess, we will, but let's just put 0 for now. So the addition of retained earnings is the profit, 76 minus the dividends, and that is $653. So we grew retained earnings by $53 in 2017. I guess we're projecting to grow it by $53 in 2017.